Well, good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacqua here in London. Now, it's been a big week for UK banking after the shock resignation of HSBC's chief executive, Noel Quinn. We've also had a flurry of earning reports over the past week, Standard Chartered topping estimates in today's results. So for a fully interesting and in-depth look at the banking sector in the UK, I'm joined by Bloomberg's Tom Metcalf and Paul Davies from Bloomberg Opinion. I've been looking forward to this conversation all week because there are so many questions I had about why Noel Quinn, first of all, left, Tom. I mean, there's many reasons that have been cited, but does it leave a hole in the UK bank? Is it even a UK bank or is it more of an Asian bank?
Well, I think, operationally it's really an Asian bank. And talking about reasons to leave, that's one of the reasons he gave. It's such a grueling job right at the top. He's one of those banking executives that has to fly commercial. I mean, don't feel too sorry for him. It's probably a very nice class of travel he goes. But it's a really hard job. He's travelling twice a month. And so after 5 years, in his telling, at least took its toll. But I think also there's, of course, the politics at a bank like HSBC, the interactions with the very powerful chairman in this case. And, I was reading Paul's article or column about it, and I think he conveyed very nicely that, for me, it was a big surprise. I got a 5 a.m. call when the news broke, but when I read Paul's column, I was like, I guess there is actually, a very good case to be made. This is a good time for Noel Quinn to be leaving.
Wait, why does he fly commercial when I imagine many Wall Street titans have private planes? Is it the UK? It just feels better, right?
Flying private is, I imagine, much nicer. But that's the difference, say, between a CEO of an HSBC and a CEO of, say, a JP Morgan, right? A, you're getting paid half as much, and B, there's a lot more focus on kind of the cost level, which is really fascinating. Probably after a while becomes quite a grind.
Paul, you've written some really great columns, kind of explaining what you think, what he's achieved so far, and also the kind of person that the bank needs to put in charge going forward. Has Noel Quinn achieved what he set out to achieve?
I mean, I think so. I mean, I think it was put there to continue a lot of the work that Stuart Gulliver started, many years before, which was to kind of, slim down and make the bank more focused on kind of its key markets and to kind of make more sense to investors in lots of ways. It was like, many years ago, they used to call themselves the world's local bank. They tried to do everything everywhere, and it was too much. It was too costly. They didn't make the returns in enough markets, and so they really needed to refocus. I think, he's sold a lot of businesses, he's cut costs, he's cut the balance sheet right back, and he's made it make a lot more sense. The challenge now, which has always been a challenge for HSBC, is to find, it's still a huge bank, is to find enough kind of extra business, some growth, to kind of make a difference, to kind of show some change in the bank, yeah.
So who's the ideal candidate, actually?
So somebody who isn't, that desperate for a large amount of money. I mean, like Tom said, they're quite sensitive to costs. He was long one of the lowest paid CEOs of any kind of major bank, only on about £5.5 million a year. Like the end of last year, his first long-term incentive plan kicked in, and that went up to about 10 million. So anyway, you compare him to like Jamie Dimon, it's like, it's like a fifth of the pay or something like this, not even half, But I think what they will really want is somebody who, maybe with a good background in kind of, wealth and private banking and personal banking. That's kind of one of the main hopes for growth in the future, a kind of a, more capital light, kind of, higher return business, and particularly in Asia, which is still, despite China's slowdown, one of the great sort of sources of wealth creation and burgeoning middle classes and affluence and so on and so forth. Yeah, and then somebody probably with a bit more sort of maybe digital nous to kind of, help modernise the bank still too.
To both of you, does nationality matter? And is it more of a politician's role because you're dealing with, the Chinese authorities as well?
Well, there's a lot of different things here. I wouldn't say any specific nationality necessarily is kind of top of the draw. The most interesting thing for me would be, is it an internal or an external candidate? Yeah. They've come out and said we're looking at both. You would think for a bank like HSBC, it's so complex, such a massive bureaucracy. Internal candidates have normally been preferred, but of course maybe now's the time with Noel Quinn having done so much of a hard graft. Do they bring in someone completely from the outside to shake things up? I think that would be a surprise, but it's possible. But the other big thing, and let's go back to that massive debate they had with Ping An, their largest shareholder, is clearly they want someone with deep Asia focus, deep Asia knowledge. If they could magic up a perfect candidate, it would be someone from Asia, but I don't know if when you look at the people who might put their hands up and who's around, if that perfect candidate exists.
We also know, so the chairman is also leaving in 2 years. And we were kind of, are there any big names without, in banking that could do this job that are currently without a job? Or do you think they'll go internal?
So I think Simon Cooper, who spent a long time at HSBC and then moved to Standard Chartered, he relatively recently left there. He was head of their investment banking business. I mean, there's a couple of other people, external candidates that have been mentioned. Helen Wong, who runs OCBC, who previously spent in Singapore, who previously spent nearly 30 years with HSBC. Very impressive executive. I met her about a decade ago in Shanghai when she ran the HSBC China business. But she is 62, I think, so, she's no younger than Noel Quinn, and she's not been a CEO of OCBC for that long. And then the other external candidate is Charlie Nunn, of course, who currently runs Lloyds Bank. Again, he's much younger, an impressive executive. He's done a pretty good job at Lloyds, I think. But again, he's not been at Lloyds that long. And he's another person who also had a decade or so at HSBC before. So all three external candidates that have been mentioned are they're still sort of HSBC people as well. It's like the apple's maybe not going to fall that far.
We also had Standard Chartered. I mean, how's UK banking doing in general? Standard Chartered, again, with a lot of presence outside the UK. So it's kind of like UK-based, but also not that UK in its complexion.
Yeah, and that's always the interesting thing about the UK-listed HSBC and Standard Chartered is the story there is really much more, in both cases, emerging markets, certainly Asia. It's a very strong set of results as I read them today. I think shares are up 7% when I last checked. And, it's a couple of things. They seem to be attracting more wealth customers, the holy grail for so many bankers right now. And also the traders at Standard Chartered have continually delivered over the past few quarters. And, that their trading arm doesn't get much credit. You don't normally think of traders. You don't think necessarily Standard Chartered, but they're doing a good job. And so broadly speaking, the street is responding pretty positively. And for me, the other fascinating story here is Standard Chartered. You've now got the longest serving UK bank executive. He's just seen, I think, off his fourth HSBC CEO or something like that, Bill Winters. And for me, that's another question is, he's been for many, many years trying to transform Standard Chartered. Does this, latest quarter suggest, finally, there's light at the end of that tunnel? Or, as in the past, might one good quarter be followed by a nasty surprise the next?
One of the other things we're trying to explore is, and I know we'll speak about BHP and whether there's a pipeline for IPOs and what this means for companies. But I know you were also interested in talking, Paul, about a possible merger in Spain. And I don't know whether there's a possibility of a merger amongst UK banks. It always feels we're a little bit overbanked, but yet these are also big banks.
Yeah, I mean, I think there's maybe some smaller banks that could roll together, or maybe sort of parts of their business get taken out by some of the larger banks. So obviously, Barclays has done a couple of deals in the last couple of years. It took a book of mortgages from Kensington. It took on the Tesco Bank last year, I think. And there's a bunch of sort of smaller banks that could, maybe be combined together that might make a bit more sense and be a bit more competitive as larger entities. So, within the UK, we could see something like that. There's not going to be deals between the large banks in the UK. They're already too dominant. They already have too big market share, which is part of their problem. Part of the problem for a bank like Lloyds is how do you grow when you already massively dominate your home market?
Yeah, I mean, if you had to rank the UK banks, or at least, how's Barclays doing? We're kind of almost at the end of earnings season in the UK.
Well, it depends what you're looking for in a UK bank, right? Like a Lloyds, as Paul said, absolutely massive, dominant here, big mortgage. A lot of those kind of businesses that shareholders tend to value a bit more highly than when you look at a Barclays with that real big global investment bank, as they call it. In terms of how Barclays are doing, there does seem the strategic reset is being embraced. I think the hardest thing there is just it's a huge sort of existential thing for them is can they really maintain what they clearly want, which is a big investment bank, but at the same time, is that really what shareholders want? And, it's just a tough sort of path to try and follow for the execs there.
All right, thank you both for joining us. Paul Davies there from Bloomberg Opinion, and Tom Metcalf stays with us to understand about the City of London and, of course, what we heard not only from Shell, but BHP and Anglo. Coming up, the UK oil giant Shell reporting a strong set of first quarter results, beating expectations. We'll be discussing the numbers, plus what the future holds for commodity companies here in the UK. That's next, and this is Bloomberg. Oil giant Shell beat expectations in its first quarter results and announced it will buy back $3.5 billion of shares. Now, uncertainty remains over its future on the London Stock Exchange as a Shell chief executive talks of the company being undervalued compared to rivals listed in New York. Well, let's unpack all of this with Will Kennedy, Bloomberg's senior executive editor for energy and commodities, and also to understand what this means for the City of London. Tom Metcalf is still with us, Bloomberg's EMEA finance and investing managing editor. So thank you for sticking around, Tom. Welcome to the program. Well, I mean, there's a lot going on in the commodity space, but probably the most interesting, and thank you again for coming on the podcast, where we really, dig deep into if Shell leaves, if some of these companies, if Total leaves France, what is the FTSE left with? Shell beating expectations today. Like blowout.
Good morning. Yes, it was a really good quarter. It was hard to find anything to say that didn't go well. Earnings were ahead of expectations. They maintained the pace of buyback. Trading performed extremely strongly. They kept a tight lid on capital spending. Debt fell. So, yes, all in all, pretty good quarter.
So should we take it seriously when they say, look, there's not enough capital markets? Or is there something that, we explored this also, there's this surprise that was not a surprise to you, but a surprise to most. BHP offering to buy Anglo.
With Shell in London, obviously Shell is the sort of jewel in the crown of the London stock market. It's the biggest. It's the biggest company on the stock market. It is one of the world's biggest oil companies. But the CEO's complaint is that when you look at the company next to Exxon in the US in particular, the valuations aren't the same. And we talked about the fact that investors in Europe are not keen to own oil and gas, so they're chasing a smaller pool of investors compared to the US, where investors are much more relaxed about owning oil and gas. And that's why while someone at Shell and Total, Patrick Pouyanné, have opened up this conversation about, well, should the stock be listed in New York? I don't think we're there yet. Shell's clearly doing everything it can to close the gap. They're buying back shares. They're talking up the valuation. Investors may notice, they may notice the value, but I think if this situation continues for some time, I do think it's a serious possibility that Shell really looks at it hard.
Well, I find it incredible. When you look at the FTSE, I mean, it's so commodity rich, right? BP, Shell, some of also the miners. Is this historic?
It is. I think it goes back a long way. Oil and gas, obviously, BP and Shell are two of the oldest oil companies in the world, British based, with heritage in different parts of the world, and it remains an expertise for the UK. And I think mining, likewise, there is still a community of people in London who understand natural resources very well, and all the bankers, the analysts that come with that. And that's still strong. I mean, if you look at the FTSE 100, the top 10 companies, in that you've got 2 oil and gas companies and 2 miners.
Yeah, so, the question is, if, for example, BHP buys Anglo, and Anglo actually leaves the UK, is this a problem for the City of London? Again, it's quite complex, because you're talking about investors needing to invest in some of, the dirty money, fossil fuel and mining, but also the City of London is quite reliant on it.
Oh, yeah, absolutely. I mean, it would be a big problem. As Will points out, City of London, historically, energy, commodities, finance, that's really where it's sort of listed companies are. And, you lose, a big company like, for example, Shell would be historic and an absolute disaster because there's so much ancillary stuff that comes with having, big listing like that. And you'd eventually, it wouldn't be like an immediate collapse, but there'd be a sort of slow puncher of talent and stuff. And it just makes the City of London's job harder of attracting capital, attracting deals. Of course, City of London's not just the equity market, but it's one of the, a key plank. So I'm sure they'll be doing everything they can. And it's interesting looking across at Paris as well with Total. You've had a pretty strong political statement there on their desire to keep it, and that's true here as well. But, of course, ultimately, it's the money that talks. And, it's still a way away, but I can certainly see a world where, yes, some very big companies, not just the smaller ones we've seen in London, start to, really genuinely move abroad.
I mean, there's a number of reforms, coming for capital markets in the UK. Will they help? Or actually, are they still not, ambitious enough?
Yeah, I mean, I think the trouble is in what can practically be changed. There is no sort of silver bullet out there that everyone's thinking can be done. It's very much, some of it is a bit of sentiment-driven and, some interesting comments that, if maybe London can get some one big deal, can get some one big IPO, that might change the sort of dynamic here a little bit because the strengths of London aren't, drastically worse than they were, say, pre-Brexit. but it just puts it in a harder position to compete as a truly sort of international financial centre, at least in certain sectors, so tech. And, as Will points out, oil, normally a huge area of strength for London. But, yeah, if you compare Exxon to Shell, you can see why people are considering a move.
Yeah, at the same time, because of BHP and others, is there, are bankers telling you that there's more in the pipeline in terms of M&A? I mean, we've had a tough 18 months, and I keep on hearing about green shoots, but we haven't really seen them on paper yet.
Well, that is the good news. There's at least there's a lot of chatter. So you've got to wait and see the evidence, right? But already, at least in banking, you've seen a few deals come through in Spain. Those animal spirits might be seen as returning. So I think there's a lot of expectation on, there will be this bounce back. You've seen that kind of come through in some results like Goldman and Morgan Stanley. And, yeah, it'll just be curious to see where they land. In London, it might well be more take privates, which is probably not what the city wants to see, actually.
Yeah, probably not. The BHP decided, actually, a couple of years ago to delist from London. Was that, has it been a success in terms of what they've been doing?
I think most people see the structure as simpler, and it makes the company probably more agile. I think it would be harder to do the deal that it's proposing with Anglo if it still had that slightly complicated dual listing structure, which was a hangover from an acquisition they previously made in the early part of the century when they bought Billiton. So BHP has historically been an Australian company. But, yes, I think it has made them more nimble and put them in a position perhaps to take another UK-listed mining company out of the picture.
Well, what I also find very interesting is that you currently have a chancellor and you currently have, a lot of policymakers looking to the future when you look at valuations in the US, saying, look, it's AI, it's the new economies, it's these things that will give us growth. But, of course, Anglo has copper, which is crucial to anything that we use and for the energy transition.
That's exactly right. I mean, that is the big narrative to this deal, is that BHP is an extraordinarily profitable company, has these enormous cash flows from their giant iron ore mines in Western Australia. It sees an opportunity to take that cash flow, take that balance sheet, and use it to make copper acquisitions, because I think Mike Henry, the CEO, has a real conviction that copper is going higher than here, and that's the business he needs to build to make BHP ready for the future. And actually, its own portfolio doesn't have much growth. So we might see more people making copper plays, but the universe of targets is small. I think it's going to be a very interesting couple of months ahead.
I mean, I was going to ask you, how long are we going to speak about this possible deal? Are we going to see, White Knights or other people trying to buy this asset? I mean,
it depends. It depends on a number of things. I think the expectation is that BHP, well, they do have to shut up or put up by the 22nd, so about just over 2 weeks' time with an offer. I think some people expect they might sweeten that offer, but even if ultimately BHP Anglo doesn't happen, Anglo will have to change. The point is, it's copper. A lot of analysts are saying that its copper business is actually worth more than the market cap of the whole company, so they have to find a way to release some value. They've got Elliott, the activist, as a shareholder now. No matter what happens, Anglo will not look the same in a year's time.
All right, thank you both for joining us, Bloomberg's Tom Metcalf and Will Kennedy. Now, be sure to subscribe also to our podcast that I host with Allegra and Dave as we uncover the best stories and speak to the people in the know. Coming up, the UK high street retailer Next reported a solid start to the year. But as forecasts remain unchanged, we discuss how the unpredictable British weather, oh yes, very unpredictable, is dampening expectations for UK stores. That's next, and this is Bloomberg. Welcome back. Now, UK retailer Next has reported a solid start to the year as first quarter sales showed easing price pressures and boosting shoppers' desire to buy. The high street chain stuck with its outlook with a cold April expected to hit second quarter sales. Well, joining us now is Bloomberg's Sabah Meddings. Sabah, I mean, when you look at Next, it's kind of like a little bit of a bellwether, but what do the results tell us about the performance of some of their peers?
Well, what we saw from Next is there's no escape from the weather. We had quite a warm spring last year, which meant people were out buying their summer clothes nice and early. But this year, I mean, we've all seen the weather outside today. I think there was a thunderstorm this morning.
I mean, it's so depressing.
It is. But it really does affect what people shopping habits. And what we want in the UK, I guess, for our retailers is quite strong seasons, which will drive people out. So Next did guide, rather than flat sales this quarter, 0.3%. decrease, which actually could have quite a negative sentiment if we think about Marks and Spencer's, which is reporting later this month, and also ABF, the owner of Primark. We could see, this is sentiment that people will read across for their results as well.
I mean, it's kind of common sense. So you're cold, you don't want to go and buy what's in the store, which is the offerings for summer. What does it do with the stock, and why did Next do so well compared to some of the others?
Well, Next, just on stock, what we have seen is that people have got a lot of summer stock, in their stores, and if people aren't out buying it, they may be forced to discount. You're right, Next has often kind of beat the sector, and a lot of that is to do with its CEO, Simon Wolfson. He was quite quick to realise that perhaps being on the high street in as much as they were before perhaps wasn't as sensible, so they moved out to out-of-town retail parks. And they also have this technology platform where they brought on third-party brands. They've bought Reese, they bought Made.com, they've got Fat Faces on there, so there's much more for customers to buy, and then they can lend this technology out to other brands which might want to outsource their online shopping, and they're expanding overseas. So there's kind of quite a few factors that Wolfson has deployed.
How are supermarkets doing?
Supermarkets, the interesting one at the moment, I guess, is Asda. They're in the middle of a refinance at the moment, and definitely there's lots of questions about the direction of that chain, which is owned by the private equity firm TDR Capital, along with the Issa brothers, the billionaires from Blackburn, who kind of grew their fortune on gas stations and are now sort of they own half of Asda. Part of the problem is that TDR is trying to buy out one of those brothers, and there have also been questions from UK MPs on whether Asda, which was always the price leader on everything from petrol to food, has been overcharging customers, perhaps at the pump. So there's a few, and they're also looking for a new CEO with Mohsin Issa stepping down.
But the weather also affects them, right? Because we don't buy barbecues.
Well, exactly. There's probably they haven't got their seasonal stock out. People are still perhaps cooking a roast instead.
There you go, roast. Okay, happy May, everyone. Bloomberg's UK business reporter, Sabah Meddings. Now, another reminder to, of course, subscribe to our In the City podcast. This is Bloomberg.